Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, calendar spreads, now could be the time. We'll take a look at calendar spreads, also called time or horizontal spreads, as vehicles that can be applied in a number of situations, no matter if you have a bullish, bearish, or neutral market outlook, and we'll go through it all in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you, and investors like you, with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast. So if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, calendar spreads, now could be the time. Joe?
All right, Nick. Well, thanks very much, and thanks really to everybody for taking time out of their day to join us for today's presentation. Hopefully, Nick, by the time we do another one of these, everybody maybe won't be suffering quite as much from this dreadfully long winter. Now, not everybody who's listening today, I guess, has suffered through that winter, but I know me here outside of Philly and you outside of Chicago, certainly it's been a long, long winter, and, before long, hopefully it will end. But let's get to our calendar spreads. Now could be the time. Calendar spreads are really pretty straightforward spreads, and not knowing how many of you have used them, I'm anxious to get through this presentation and field some questions, as Nick suggested at the end. As always, we start off by talking about the options disclosure document, characteristics and risks of standardized options. If you're in the options space, you know about that book, and it offers really some great information about the options product, so you can either get that from the OCC or from your broker, but be sure to get a copy of that. For those of you joining us for the first time, you may not know exactly who the OIC is. We are the educational arm of the listed U.S. options industry, and the different exchanges on the slide here are our partners who fund us throughout the course of the year to allow us to bring options education to all of you. Real quickly, we've got BATS, BOX, SIBO, ISE, the Miami, NASDAQ, the New York Stock Exchange, and the members of the OCC, which is the clearing corporation. Again, real quickly, BATS, an electronic exchange out of Kansas City, BOX, an electronic exchange out of Chicago. We've got the SIBO, the original exchange, and they've got their electronic exchange C2. ISE was the very first electronic exchange founded in 2000, and their new platform, ISE Gemini. The Miami is the latest entrance into the exchange group. NASDAQ has 3 exchanges, as you can see, and the New York Stock Exchange has 2. And again, it's the OCC, the Options Clearing Corporation, that is responsible for matching all option trades that take place on the exchanges. Speaking of option trades that take place, again, for those of you just joining us for the first time, This is a snapshot of the growth in the options industry from inception. Bottom left, we've got 1973 up through 2013. As you can see, the growth in the industry really from 2000 going forward has been nothing short of extraordinary. I mentioned earlier that the first electronic exchange was the ISE, founded in 2000, and I don't think it's a coincidence that options volume, since investors got the ability to access the markets electronically, our volume has absolutely gone wild to the upside. So the 12 exchanges, we average about 17 million contracts a day. And as you can see, over the last 3 years, the industry has exceeded over 4 billion contracts over the course of the year. Our presentation outline, I'm trying to move to Nick, but we're bogging down a little bit, so I may need your help.
We're having a little problem? Sure, Joe, just let me know when we need to advance the slides, and I'll take it from there.
Okay, bear with me 1 second, please. Let's try it one more time. Okay, I'm going to ask you then, Nick, to help me support. Basically, moving through slide 5 is our presentation, our outline. We've got basically we'll be reviewing calendar spreads and talking about the different features in calendar spreads, motivations, the effect of time and volatility, risk-reward profiles, and then just obviously reviewing the fact that these things are debit spreads, how to establish them, and of course we'll walk through some examples as well. Next slide on 6, Nick, we get into the whole idea of spread basics, and really there are 3 types of spreads out there that I think are the foundation of spread trading. One is the vertical spread, and when we talk about these 3 broad categories, vertical is where always all calls or all puts in the spread combination, same expiration, but different strike prices. And as you can see on the slide, in our example, we've got either May or July calls, the May 50-55 call spread, the July 50-55 call spread. If we're long the 50 and short 55, that would be a bull call spread. If we had it the other way around, where we're short the 50s and long the 55, it would be a bear spread. So that's one of the broad categories, and that's the vertical spread. The other, the second category, which we will certainly be focusing on tonight, are the horizontal or time spreads. Again, all calls or puts, same strike in the horizontals, but different expirations. So a couple examples, same July, May time period, long the July 50s, short the May 50s, long the July 55s, and short the May 55s. So that would be a couple examples of the horizontal or time spread. And then lastly, we've got the diagonal spread. And that can be sometimes confusing for investors, but same situation where it's all calls and all puts, but different strikes and different expirations. So in our example here, we were long the July 50 call and short the July 55. That'd be an example of the diagonal spread. So moving on and getting onto tonight's topic, calendar spreads. As we can see, in slide 10, what exactly is a long calendar spread? Well, it's a spread where we're short a near-term option and long a further-term option. Same strike price as I had mentioned, all calls, all puts, always a 1-to-1 ratio, and we've got that selected strike price generally at the money. We'll talk about how sometimes we can do other strikes as well to accomplish, different profit potentials. But generally, when we talk about calendar or time or horizontal spreads, we're generally talking about the at the money spread. Slide 11 talks about, the expectations for the underlying. Generally, if we're talking about an at-the-money strike price, we're essentially talking about picking a strike right where the stock is. So we're neutral on the underlying over the period of time that we get long the one call and short the other, assuming we're doing it on the call side. So typically, we're neutral on the underlying. But as I mentioned, picking different strikes can allow us, to be either a bullish or bearish with the calendar spread. And as I'd mentioned, whether it's the calendar, the time spread, or the horizontal, they're all the same thing. The verticals and diagonals are certainly something else. So a couple key components on slide 12 are the time decay and volatility aspects of the time spread. Of course, time decay and volatility really come into play in all aspects of option use and trading, whether we're talking about individual options or spreads. Frankly, it's not much more important than, the whole idea of time decay and volatility. Time decay we're familiar with, certainly. We're long options we pay, we're short options we collect. The idea with the time spread is that we're going to collect more in theta than we're going to give up, on the long option side. In terms of our implied volatility, the time spreads are long volatility spreads, and the further you go out in time, your options will have more volatility or more vega, and depending on how advanced you are in your options knowledge and how familiar you are with the Greeks, each 1 point change in implied volatility can impact the value of your spread in a positive or negative way. So slide 13 speaks to the two expirations that we have in the time spread. We've got the shorter dated option, and then we've got the longer dated option. And as I mentioned, the motivation in these spreads is to take advantage of the short-term time decay. The long option, is not or shouldn't lose as much value as that short month option, depending on where the underlying is. Always important, in any option strategy or any use of options in general, the use of options and the choice of spreads really gets down to, what your opinion is on the underlying. So much starts with the underlying itself. So the whole idea of implied volatility is quite important, when you talk about the debit that you may have to pay for these time spreads. In terms of the time spread at expiration and maximum profit potential on slide 14, it can be, our maximum profit potential is going to be right at expiration with the underlying going out at expiration just below that strike. That way we don't have to worry about assignment, and what would happen with the stock just below the strike, we should have maximum value for that option that we're still long. So that's our maximum profit scenario. The underlying is going to be right at that strike price where the short option, expires just slightly out of the money. No assignment on the short contract, and that long option will have maximum value. And again, the value of that long option will be dependent upon, the implied volatility level, and whether that implied is the same level as when you put on the spread. If the implied has gone up since, the debit you paid for the spread, you'll have even more of an increased profit. If the implieds have decreased, you'll have given up some of your potential gains. Now, the maximum profit in terms of calculating it in advance, that's hard to do because you really can't be sure what the value of that long option is going to be. If we go back to one of the other broad categories of spreads, the vertical spreads, we know darn well as soon as we put them on what the maximum value can be. In the vertical spread, where, in our example, we were long the 50 and short the 55, the maximum value of the vertical spreads is always the difference between the strikes less the debit we pay for the spread. That's, the vertical spread. But, because of the wild card of what the implied is going to be and the value of that long option after your front month option expires, it's hard to ascertain exactly what the profit potential will be. A couple good ways to check that out. You can, pay attention to your favorite underlyings and watch a couple of the time spreads expire over time. Maybe you're short the weekly or the standard monthly option, but look at the spread, the debit between, those particular months, and watch a couple months and see whether you get expansion or contraction of that debit. That'll give you an awful good sense. Another good way to, check out the potential returns on a time or calendar spread is to look more closely at the volatility levels of the particular underlying options and see, when you put on this spread, are the implieds on the low end or on the high end. So, again, it's hard to ascertain exactly what the, potential profits or loss, profits will be because of, those couple variables. But certainly there are tools, and we've got those tools on the OIC's website at optionseducation.org, where you can go in to the pricing calculator and the option simulator and try these different positions, move the days to expiration, move the implied volatility, move the price of the underlying to see what kind of potential profit or loss may be gained from the spread. At expiration in slide 15, we talk about maximum loss at the near-term expiration. And we know what our downside is, with time or horizontal spreads. We know our potential downside, our maximum loss, is the debit we pay for the spread. And that's so often the case, in multi-leg option strategies. The maximum downside is our debit. So clearly defined in advance is, how much we could potentially lose. Now, why would we potentially, lose our maximum debit? Well, there are a couple different reasons. Again, the premise for doing an at-the-money time spread is we think that the stock's going to hang out, or at least at expiration, be right about the strike, and ideally just below the strike. Well, if our forecast is wrong and the underlying moves away from the strike in any meaningful way, well, the value of that time spread is going to collapse. So that's one way, we can have significant loss to the debit paid for the spread. If both options are out of the money and worthless at expiration, clearly we're going to lose the debit. Now, I would hope that in our management of this type of position and others, that we wouldn't wait until that long-term option also is out of the money and have that debit go completely to zero. I would think we would ideally close the position for a loss, collect some of the debit back, and then move on. Also, if both options are deep in the money, not out of the money, that's going to suggest that the underlying has moved dramatically to the upside. So once again, that being the case, the spread between the option months will decrease. So the potential scenarios when the debit paid is going to shrink and maybe shrink dramatically. So slide 16, talks about decay, and as the slide says, that's a given. We know it's going to occur. What we're not sure about is the rate of decay, but generally over the last 30 days, the rate of decay does intensify, as the slide suggests. And I think we all, well, for those of us brand new to options, we may not know, but at expiration, options are only worth intrinsic value. For those of you brand new to the space, intrinsic value is the in-the-money amount. So if we got a stock at 51 and we're long the 50 strike, if we're long that 50 call and the stock is out at 51, the value of the 50 call would be $1. So that's just an example of how intrinsic value works. Options at expiration are only worth intrinsic value. If there's no intrinsic value, the options, expire worthless. Slide 17, we talk about establishing the time spread. And generally, calls are used, but there's no reason, why you can't use puts. Calls tend to be a little more liquid than the put side, depending on what underlying you're using. And as we've said, these things are generally done at the money. If they're done at the money, it's essentially a neutral spread. We're looking for the underlying to stabilize right around this strike at expiration. Slide 18 talks about short-term options, and typically anywhere from the weeklies to 30 or 60 days out are the options that are going to be sold. Time decay, as we mentioned, does really begin to increase in that window, between 45 and 30 days of expiration. Longer-term options are obviously going to be more expensive because the more time we pay, the more time we buy, the more expensive the option's going to cost. And so that's where we get into the whole idea of how much of a debit are we going to pay. We buy a fairly longer-term option and we decide to sell a weekly option, that's going to be a significant debit. So that's another consideration as you're trying to decide what options, what months do I choose. You may back into it from, what am I willing to spend basis. But again, do your analysis, look at the change in implied volatilities, look at these time spreads over a couple different cycles, and see what kind of expansion or contraction you get when the stock is right near the strike. Slide 19, specifies, what options we may consider buying or selling. And I think I may have said this before. On the sell side, generally we're looking at the standard monthly option. With the advent of weeklies and certainly the popularity of weeklies, I think they've become a real tool for retail investors on the sell side as well. 7 to 8 days of life in those weeklies. They're established on the Thursday prior to the following Friday expiration. So if you were to buy a longer-term dated option, maybe you could sell weeklies week after week after week and really put a significant return together. Now, that's going to assume that the stock's not flying all over the place. Again, maximum profit, like we said earlier, is going to be with the underlying right below the strike at expiration. So it's always, it can be a challenge trying to figure out exactly where that stock will be at expiration. But on the sell side, it tends to be the weeklies or the standard monthly options that investors sell. And then on the long side, on the buy side, standard monthly options with more time or leaps. And again, if you decide to do weeklies, that's a position that has to be managed, much more closely, more aggressively, because of the shortness of time. You've certainly got accelerated decay, but you've got the potential for, the option being in the money, and that would put you into a different position entirely if you happen to get assigned on your short weekly option. Let's look at an example on slide 21. Here we are late March. good old favorite stock XYZ, $50. And we're going to do a call spread here with implied volatility at 30%. So we got a few different choices. We got the April, May, or July calls. And, again, looking at what kind of debit do we want to put together, other considerations maybe. When does the stock announce earnings? Do we want to position around a corporate announcement like that? What is the impact of the spread around earnings? Certainly questions you need to ask yourself, and frankly, study some of these cycles as you go through earnings. And as I mentioned, balancing that debit between, what do I want to risk versus my potential reward is quite important. So in the example, we decide to sell the May 50 call for $250 and buy a July 50 for $375. What is important to me is that net debit paid. We're talking about $1.25. So we're going to be long the July May 50 call for $1.25. Slide 22. We are just kind of talking about the stock at 50, and as we get to May expiration, if the stock is just below $50, obviously the option will expire just out of the money, has no value. So we'll have kept that time premium. Where does that leave us? That leaves us long the July 50 call. Now, a couple different things we can do here. Potentially we can just close the spread. We could buy back the May 50, sell the July 50, and hopefully have made a profit with that. We could let the May 50 call expire and, just stay long the July 50. Maybe our opinion, we've turned more bullish on the underlying. And so maybe we just want to stay long the July 50. Another thing we could do is, after May, we've got June. We could get into if we still believe the underlying is going to hang out right in this 50 range, we could sell a June 50 call and have the 30-day spread rather than the 60-day spread, the July-June 50 call spread. But again, this whole idea of theoretical value for the July comes into play. Your all-important opinion on the underlying is very important, and these are the decisions that you need to make in managing this position. Another consideration, going back to the three different types of spreads, you could turn around and sell a July 55 call and roll this thing into a vertical spread if you happen to be more bullish on the stock. But, if we just walk through the example here, assuming the stock's still at 50, the May 50 call goes out worthless. That July 50, assuming the implied volatility has remained constant at 30%, still with 2 months to go to expiration, we're looking at a value of $2.70 on the July 50, minus the $1.25 debit we paid, leaves us with a very, very handsome profit of $1.45. So, that's how these calendar and time spreads work. Slide 23 is just the chart depicting maximum profit. And for those of you in the option space for quite some time, hopefully, a chart like this pops into your head every time you put on any position, whether it's a long call, long put position, whether it's a two-legged strategy, three or four-legged strategy. Hopefully in your mind, at what point at expiration you're going to have your maximum profit, where your downside risks are, and if you can visualize a P&L graph like this in your head at expiration, you're well along in your options knowledge, which would obviously be a good thing. Slide 24 shows a little different scenario. It shows our solid dark line, representing what we saw on the previous slide, volatility at 30%. Now the dotted line shows, a profit still with the underlying at 50 at expiration, but not as much of a profit. And why is that? Because as we mentioned, when we talk about a long call spread, we've bought time. And the more time we own in an option, the more volatility we own. So it's a long volatility spread. So if implieds are less than 30, it's fairly obvious that, we still have potential to take home a profit, but that profit is going to be less than if the vols had stayed at 30 or gone higher. So, slide 25 talks about the investor choices. I think we talked about that just a little bit already. The neutral spread investor, the initial intent was to just sell the spread to close it on Friday for your profit. And that's assuming the stock is still in this 50 range. So that would be, one handsome profit, putting out $1.25 and bringing back 145. I'd call that a home run. Remaining neutral, if that's our opinion on the underlying, again, we could sell a June 50 call and get into the 30-day time spread. And if we are more bullish on the underlying, we could just hold that July 50 call or roll it another way, as I mentioned, maybe get into a vertical spread. So in terms of managing the position in slide 27, in advance of expiration, if XYZ drops or rises significantly, well, as we talked about, our forecast was for the underlying to hang out right about the strike price where we put this thing on. If the stock's going to rise significantly or fall significantly, the value of that time spread is going to decrease. And a good way to take a look at that is, we go back to our $50 stock, look at the value of, any $50 time spread, look at the 40 strike, and look at the 60 strike. Look at the 45 and the 55 strikes and see, assuming we're talking the same months, see how those spreads contract as we move away from the strike. It may also give you a pretty good idea as to if you are long it can give you a good idea as to the width of a spread at expiration, seeing the value of that at the money spread. And one thing we have to be cognizant of is the potential for assignment, especially, if we're doing the weeklies. I mean, it's going to be the same case with the monthlies. We're just not going to have to manage that as frequently. But, if we get into a situation where we're assigned, and that's either going to be right at expiration because the underlying closed either just above or maybe, more so above the strike, we're not going to know really in advance. The only way we can expect assignment in advance of expiration on our short option is if the stock has obviously rallied, if we're on the call side, and we've got an option that is now deep in the money with no significant time value. So there's that potential for assignment, and then also right at expiration, depending on where the stock, it may be moving back and forth around that short strike, you've got to manage that position because, you can close it out by buying the front month and selling the long-dated option as we suggested in our example. If the vol stayed the same, we look to make a handsome profit. But if we allow ourselves to get assigned, we've got a totally different position with a totally different risk profile. If we're assigned, we're going to be short. Let's say we get the spread on one time. We're going to then be short 100 shares of stock. We're going to be long one at the money call, which is going to be just basically a 50 delta call. So we're actually going to be net short deltas. And additionally, and very important, is that your brokerage house is going to want you to put up a heck of a lot more money for the short stock in that position. So there may be some of you out there who want to roll into that type of synthetic position, long call short stock, but that's the minority. Most certainly retail investors are just going to either want to close out that position or roll it some way. Slide 28 talks about legging out of the spread. It can be risky legging depending on how volatile the underlying is. If the underlying is moving all over the place, certainly that's a risky proposition. But if you've got a stock that's not doing much, legging out is not a big deal. But we always suggest if you're going to leg, it's a good idea to leg out of the short side first, only because if you get caught in your leg, even if you're losing, if the leg's going against you, your maximum loss is just a debit for that long option. If you undo the long side first and you're hung out there on the short option and the underlying starts to move against you, certainly the short option has a far more significant risk profile, and you really want to beware about that. Being naked short options, is a whole different risk profile, and one oftentimes that your brokerage house, may not be too happy about. We did briefly speak about the ability to look at time and horizontal spreads in a neutral or bearish way. So if we take our $50 underlying XYZ at 50, and we're bullish on the underlying, depending on how bullish, we pick an out-of-the-money strike and look for that underlying to go then to that strike and watch that debit expand between the front month option and the further out month option. So, if we've got a stock that's at 50 and, we think over a period of time it's going to 55, maybe we put on that 55, time spread, and as the stock approaches 55, that front month decay is going to accelerate, where the value of that further term option, depending on implied volatility, is going to expand. If we're right on our call of the underlying, in almost all cases, the width of that spread is going to expand, and therefore you have a handsome profit. On the other side, on the bear side, again, you can do these with calls or puts. If you're talking about using in-the-money options, you just have to be very careful to guard against potential assignment. So, always be cognizant of that. If we're talking about the bearish side, we think the underlying, maybe it's going to tank. Rather than doing the in-the-money calls where the risk of front-month assignment may be far more significant, maybe, we do an out-of-the-money put spread and look for that stock to decline down to that, strike that we've purchased on the put side, out of the money at the time. But again, as the stock falls down to that long strike, we potentially would see a handsome profit with that spread expanding. Slide 31 talks about, rolling. And, we just touched on it briefly. One of the key types of spreads that are out there. I think, some investors who are fairly well accomplished in options do get into these diagonal rolls, and that gets into, being long, one side and short the other. In the examples we're talking about, typically we're going to be long the far-dated option and short the front-dated option. That would be, long the diagonal. So, it gets back to, again, what choice of strike price, always very, very important. And also the opinion of the underlying. How has that changed, and how do we then have to roll? But, if that July-May 50 call spread expired and we were, more positive about the underlying after May expiration, as the slide suggests, slide 31, we're still long those July 50 calls, but rather than selling the June 50s, we could roll up and sell the June 55s. Granted, we would certainly be taking in less of a credit because that 55 call is going to be worth far less than the 50 call, but this goes back to, what different option position do we want based on our opinion of the underlying. And if we think that underlying is going to run from 50 to 55, obviously those July 50 calls are going to appreciate significantly with the delta they have, and ideally that stock rolls into the 55 strike at expiration. and you can watch that the debit in that spread expand rather dramatically. So that's just one other potential role, that diagonal spread, as we show again on slide 32. And again, these diagonal spreads, all calls or puts, but different strikes and different expirations. That's what sets them apart. They can be an extremely effective tool for a role in this type of spread or others. So again, as slide 33 suggests, the motivation is really just to take advantage of the differential in the different rates of decay, along with your potentially changing opinion of the underlying. And really, it's the diagonal spread is really a combination of the vertical and the time spread together. Some call it, as the slide suggests, a diagonal bull call spread. I think maybe we'll roll through one more kind of roll, and I've mentioned it. Slide 35 talks about just rolling to a vertical spread. And again, vertical spreads, all calls and all puts, same expiration, different strikes. So really straightforward, gets back to, the opinion of the underlying, your timing on the movement of the underlying, and then, what type of debit or credit you want to have for this particular spread. So, if we thought that the stock was going to be stronger than our initial opinion, we could just roll into this vertical spread, depending whether it's a May or July in our particular example. Really, to wrap things up, slide 36, just an overall summary before we take questions that I know Nick's getting. The call time spread, we're talking about selling that near-term call, buying the further-term call. Essentially a neutral position when we're talking an at the money. We know it's always a debit because we're buying time. The goal here is to make more time on the time we've sold versus any potential loss on the further term option that we've bought. The maximum loss in these things is always the debit paid, and the maximum profit is going to depend on the value of the long call and the volatility levels at expiration when that front month expires. And I would just add, we talked about a couple different roll potentials. You've got that potential to roll into a vertical spread, either a vertical bull or bear call or put spread on the vertical roll, or also the diagonal as well. So either rolling up a strike or down a strike is really the other type that we talked about. So our contact information, for those of you who don't know, and I hope most of you do, we've got a wonderful investor services desk with folks in Chicago and right outside of Dallas, Texas. They're there for you 5 days a week. You can reach them at 1-888-OPTIONS. You can also IM them or send them an email if you wish. And then our website, we hope that you'll check out at www.optionseducation.org. So, Nick, I think that wraps up the formal part of the presentation. What kind of questions do we have?
Joe, a couple questions came apparently from experienced, seasoned investors, and it dealt with the concept of implied volatility. Some of these investors wanted to know that if implied volatility is high, the odds are going to be favoring those people who write the options or sell the premium. Is the converse true? When the implied volatility is low, do the odds favor those that buy the premium?
Well, it's a very good question. And, implied volatility, those listeners are really touching on one of my favorite subjects when it comes to options, that whole idea of implied volatility. And to answer the question, the lower the implied doesn't necessarily mean that you've got a heck of a lot more upside potential. It should seem that way, but I go back to what's the track record for the implieds, and that, you know, if the listeners would go to our website as one example and pull up the implied volatility charts, just like any chart, they can see whether, you know, there is movement in the implieds for their favorite underlines. And so, you know, let's use an example. If we've got an underlying that's got a range of implieds over the course of 12 months between, let's say, 20 and 35, and if we're able to put this time spread on when the implieds are down in the low to mid-20s, then I'd say, sure, you know, doing it then, you know, we've got a real advantage because the implieds over the course of the year, you know, trade on the low side, you know, at around 20, on the high side of the mid-30s. So if we can put it on, you know, with the implieds down around 20, I think we've got, you know, a real built-in advantage. But in another example, let's say we've got our favorite underlying and the darn implieds are a flat line, and, you know, they really don't move much. If that's the case, then, you know, whether we're buying implieds at a low level, well, the stock's not moving much, you're going to certainly be buying the implieds at a low level. Chances are this is not a good candidate because the implieds aren't going to move much. The difference in those spreads isn't going to happen, you know, isn't really going to move that much because the implieds are fairly dead. So it gets back to the personality of a particular underlying, in my opinion, and, you know, trying to put these things on when the implieds are low versus their range over the course of the previous 12 months, 6 to 12 months.
Joe, another question we had was from an investor with a little bit less experience and really wants to know how to get into the groove of doing these. He mentioned that he's doing conservative covered calls, selling puts, and wants to know how to move from kind of cruising in the right lane into hanging out in the middle lane and doing some calendar spreads. What would be some concrete steps to do to make that switch?
Well, let me start by talking about the risk profiles of, well, you know, broadening his or her knowledge is great, certainly. But in terms of the risk profile, there isn't necessarily any more risk in a time spread. In fact, I would argue in many cases there's less risk, far less risk than a covered call or a, say, cash secured or naked put sale strategy. So the risk profiles are actually quite a bit different. But in terms of how to move towards the time spread, and as I think when we first started, Nick, I said I used to do these spreads a heck of a lot on the trading floor. And the reason I did that was because I love these spreads. You know, they're really pretty low risk. Your risk is your debit. Now, if you're buying a leap 2.5 years out and you're selling a weekly, you know, that's a healthy debit. But, you know, if you're doing something like that, you're going to sell weekly after weekly after weekly, and in time, depending on your strike selection, will, I think, find a very handsome return. But kind of back to how do you roll into getting comfortable with time spreads? 2 key areas. Number one, you know, pick, you know, 2 of your favorite stocks and look at the value of the time spreads tonight. You know, look at, you know, the front month versus the weekly. Now, the weeklies, not all underlyings have weeklies. You know, about 320 of the 4,000 underlyings that we have product on have weeklies. But, you know, a lot of those products, all the products actually that have weeklies are extremely liquid and very popular. So chances are a lot of the listeners are using options that have weeklies. Look at the value of those spreads tonight. Look at the money for, you know, the weekly or the standard and a couple months out. Look at it, you know, a few months beyond that. Maybe pick an option 4 months out and then a year out versus, you know, the front month standard option on the short side and the weekly option, you know, on the short side. If we're talking about underlyings that have weeklies, look at how that front month and the weekly expand and contract as the stock moves around. So, make notes. Look at the debits in your favorite underlyings in the months that you choose. Start there. Pick the strike at the money, and then pick a strike somewhere out of the money and somewhere below the money. And the reason for that is if the stock moves a lot, look to see if the value of that spread as the stock goes to one of those new strikes turns out to be the same value as the spread when the stock was at the money. I'm saying a lot here. I hope people get this. But, look at the value of the spread and watch them. So that's easy. And the other thing is go to our position simulator. Plug in your underlyings, and, without having to wait, for a week or a month or 2 or 3 months for these cycles to expire, know your implied volatility level, know the day's expiration, know the strike prices, and plug in various inputs and watch that position simulator work for you. I mean, it's a tool that costs no money at all to use. We've got it. A lot of different brokerage websites have it. Use that tool. Basically, the commitment from you to use that tool is your time. But, you can really find out so much about the value of options because I'm a big believer that options generally are not that complex. I mean, a lot of folks call options, wildly complex, but, there aren't that many moving parts, more certainly than just your underlying. But you can, through the position simulator, you can isolate those couple different, aspects. The volatility, the day's expiration, the price of the underlying. Mess around with them with the position simulator and see how these option spreads may work for you. That was a long answer, Nick, but, I think it's those two key areas.
That's actually really important because, as I mentioned, we had a number of questions about that. Joe, we talked in the early part about the horizontal, vertical, and the diagonal spreads. Now, we're obviously talking about the horizontals here, focusing on that, but one of the investors wanted to know if there are any guidelines as to when you should pick one strategy over another, or if you see a market opportunity that may favor one of those.
Well, it really gets back to what's the investor's opinion of the underlying. And that goes for really all option trading. I mean, it also can be, the other's big opinion can be, what's your opinion on the implied volatility? But really more importantly is, the opinion of the underlying. And so if you put on this time spread, back to our example, the $50 stock, we were neutral. If we continue to be neutral, then we just keep doing this $50 call spread. If we happen to turn bearish, maybe we roll down into a diagonal. Again, the timing of the diagonal or the opportunity to roll to a diagonal is going to depend on how much time you bought out. If you only did, if you're long a standard option and short a weekly, the only diagonal could be doing it into a weekly. But it gets back to, what do you think about the underlying? Are you bullish? Are you bearish? The nice thing, and actually one of the things I liked about the presentation, honestly, is just think in terms of there really are only 3 types of strategies when it comes to option spread. We've got the time spread, we've got the diagonal, and we've got the vertical. I think it's great to keep it simple. We've got those 3 choices. So why do we roll to a diagonal versus a vertical? Well, it depends on time, and it depends on, again, the opinion on the underlying, and that gets back to the investor themselves and, the different homework they do and how strong their opinion is on the underlying. One more thing about the underlying, that's why I'm a huge believer that, I think you have an advantage by not trading too many underlyings. Sometimes, down on the floor, I'd be a specialist on many of the underlyings. And, you get it spread a little bit thin. If you can really focus on a handful of underlyings, that's where you can really build in an advantage. Your expertise by focusing on 2, 3, 4, half dozen underlyings and knowing, the fundamentals of that underlying, the chart of that underlying, the implied volatility levels of that underlying, what happens before earnings, with the implied, if you can really get very, very good at a handful of underlying, I think you get far more comfortable rolling into the various option strategies.
Joe, we have time for one more question, and this one is pretty quick, but I'm sure it has a long answer. Do investors ever sell the time spread?
Do they ever sell the time spread? Well, we'll make this a short answer, but yes, they do. And so the question I would say, maybe a number of our listeners saying, well, how do you sell one? Well, our examples today were long the time spread, buying time, selling the front month. To sell it means you're going to buy the front month and sell time. So you can do all the same things we talked about. Same strike, different strikes in diagonals or verticals. But what you're talking about here is getting long the front month gamma. Okay, so we're going to be short volatility and long gamma. So, what's the risk here? The risk is that our front month option, is expiring very quickly, depending on, whether we're talking a weekly or a standard monthly option. We've got that pressure that the underlying has to move rather quickly. Otherwise, our long front month option is going to expire, and then we'll be short an option, and then we'll have to either close out the spread or buy something else to offset our short option. But the answer is yes, investors do sell time spreads. The motivation is typically to sell volatility and to anticipate a move in the underlying away from that strike additionally, so we've got, a contraction of the credit, because when they sell a time spread, they're doing it for a credit, not a debit. They're looking for that underlying to either move away from the strike or for the implieds to, contract, and therefore, we have a profit. So the answer is yes.
Fantastic, Joe. Do you have any closing remarks for our attendees today?
Only that for those of you in cold weather climates, spring is coming.
Ladies and gentlemen, thank you so much for attending today. A couple of points to note: that if we were not able to get to your question, our investor services desk is ready to help, as Joe mentioned, at any time during business hours. Give them a call at 1-888-OPTIONS. They can also be reached at the optionseducation.org website. We had a couple questions about the position simulator come through. The position simulator is also available on the OIC website under the Tools and Resources drop-down, and that way you'll be able to model some of your options trades. Make sure to fill out those surveys, and remember that we're going to be holding our next webinar on March 25th. Check optionseducation.org in the upcoming weeks for more details on that, or keep an eye on your email. As a reminder, these are all archived for later viewing on OIC's YouTube channel, and it will also be available on demand through the On24 web portal. Ladies and gentlemen, thank you so much for attending the webinar today, and we hope to see you again next time.